So welcome to our webinar where we're going to talk about how to execute a successful 1031 exchange. And successful is the key word. All right. My name is Steve Peterson. I'm the broker owner of Infinity Investments. Infinity Investments is a boutique commercial and investment property brokerage. I started the company in November 2009 in Oakland, California. And if you were doing business in 2009, it was a little bit of a crazy time to start a company. Actually, it was a great time though to start a company. And if you were an investor, you were working with investors, you had cash or you had access to capital. It actually was the best time to be getting going because the whole real estate market, particularly in Oakland and the Bay Area, was on a 60 to 70% discount from where it was at the peak. So it was actually some of the most amazing deals I've ever seen in my life get done around that time. I also had the honor and the pleasure to serve as president for the Oakland chapter and the state chapter of NARAB. That's the National Association of Real Estate Brokers, which is the Black Real Estate Brokerage Association, formed in 1947. And that was an honor to serve as president here in Oakland for the Associated Real Property Brokers, ARPB, and for California, which is known as KRAP. Now, also, I've been real busy in a lot of real estate organizations, which helped me to also develop my executive prowess, as I also served as president of NorCal CCIM. And NorCal CCIM is the Northern California chapter of the CCIM Institute, which is in CCIM, if you don't know, is a designation that you can obtain, which stands for Certified Commercial Investment Member. But more importantly, it's a network of commercial real estate professionals who are the top of the top. In order to get that designation, you have to go through a series of rigorous courses and close a certain amount of business. So I had the honor of serving as president of NorCal CCIM as well. And that really helped me to learn about being an executive and not just being an independent small business, which is very, very helpful in the commercial real estate field. And so our firm, Infinity, we specialize on small to mid-sized apartment buildings and commercial real estate. We also do syndications of those properties as well. And we are based here in Oakland. We actually open up an office in Stockton, California very soon, as we're wanting to do much more business in the Central Valley. A little bit about me and myself, and we're going to get into the agenda for today. So we're going to break down, how you can understand how this whole 1031 exchange process works. And after this presentation, you will. I'm not going to go into like the nitty gritty, super basic issues of it. This program is really designed for how to execute it, right? Not so much to say exactly what it is, although I will set that up. And we're going to talk a lot about do's and don'ts. And you'll see kind of through the presentation, we're going to talk about, hey, you should do this, you should not do that. All right, very important. And we're going to make sure you understand how to avoid the most common traps that cost investors millions, either in missed opportunities or in taxes in the 1031 exchange process. All right. That being said, what is a 1031 exchange? Now, this is my layman's term. This is not out of the dictionary, but this is my definition of it. Is a 1031 tax deferred exchange when a property owner sells their investment property or business purpose property and purchase another like kind property at equal or greater value. And in doing so, the property owner can defer the capital gains taxes incurred. All right. Essentially, the purpose of the exchange is to use the property owner's existing equity in order to purchase a better asset while deferring the capital gains taxes. The purpose of an exchange is not to defer capital gains. I want to point that out. Very, very important. The deferral of the capital gains taxes is icing on the cake. That's the sweetener. That's the cherry on top. All right. What you're doing, the purpose is to acquire a better asset. And a better asset is up to your definition of what that means. It could be a bigger building. It could be a building that is in a better area. It could be a building that generates more cash flow, which is typically the situation. And for business owners who own property where their business is. It could be buying a facility that's more functional for their business. It could be a variety of issues or a variety of things, better said. The key is you're doing this to buy a better asset than what you have already, and not just to defer the taxes. And a lot of people get that wrong because they sell, they think, hey, I'm gonna sell, make all this money. I just exchange not to do, not to pay these taxes, without taking into consideration the fact that, hey, whatever you buy needs to be better than what you just sold. And a lot of times that may not be the case. So we really want to drill this in, that you can understand succinctly, you're doing this to buy a better asset. And I've dedicated a lot of my time and content that I do on our YouTube station to the 1031 process. Because as a broker, I'm in 1031 exchanges consistently all the time, basically, right? And so therefore, my goal is to put content out there to the marketplace and people I'm going to be working with to be able to help clarify what this process is and what it is designed to do. And the deferral of the taxes is the icing on the cake. It's the cherry on top, which makes this thing beautiful. All right. But if you sell your great asset, your great building that you love, and then you buy a piece of crap, you have not executed a successful 1031 exchange, even if you have deferred all the taxes that you would have incurred. All right. So let's drive that home. And I got a million videos on YouTube talking about this, breaking this down. So please tap into that and absorb this stuff. All right. But that's what I want to, I really want to get to the crux of this is this, we're doing this whole song and dance to purchase a better asset than the one you have. And a lot of brokers out there are just, when you're working with them, they just go, hey, I'm gonna sell your property, I'm gonna sell you something else. You know, we get paid commissions, right? The key though, a good broker and a good investor is really concerned with the end result. All right, because for me, the way I look at it is this is a relationship business. We're building relationships. So if I can get you into a better asset and get my commissions versus I get my commissions and I get you a piece of crap, so I get you a better asset, we're going to have a better relationship. All right. You as the investor, when you get yourself into a better asset, you're going to be closer to your goal, whatever that is in the investing world. And you're going to be advancing your portfolio versus moving backwards. And I've seen a lot of people exchange and make the wrong move. That's why I'm drilling this in, y'all. I think it's very, very important. All right. Now, we have a 9-step process that we call the 1031 success checklist here at Infinity Investments. And we had to put this process together because we do this all the time. And from a lot of helter skelter, I started my company in November 2009, but I got started in the business in summer 2003. So it's been a while and been doing 1031 exchanges, been involved in 1031 exchanges the whole time. And so we put together a 9-step process to help investors have a guide, have a source of a reference point as you're going through this process in order to ensure success. And again, our definition of a successful exchange is when you purchase better assets and you have deferred all your taxes. Now, quick note about the 1031 exchange process. You decide, hey, I sell a property, I've got $1 million of gain, I want to take out 100 grand just for myself and go to the Bahamas. You can do that. That's called boot. And that you're gonna pay all the taxes on that money that you take out. All right, you can exchange the rest, but whatever it is that you take out, which you can do, you're gonna pay tax on. Okay. And by the way, I don't believe you should be voluntarily paying these taxes, but paying taxes is not the end of the world. All right. Some people, you know, are so clinging on to buildings because they don't want to exchange because they know this is a difficult process. And then yet and still, if they would have sold, even after paying the taxes, you have a tremendous profit that you could then reinvest. Okay. What we're saying though, is if you are going to go in and purchase a better asset, make sure you defer the taxes and you follow a plan. Right. And so our first step on Our 1031 exchange checklist is to create an investment plan for yourself. Now, this just seems very elementary, and it is, but I can't tell you how many people just shooting from the hip buying property. People with millions of dollars, by the way. And that's not the time to be shooting from the hip. Let me just tell you. Imagine this investment plan as a basic business plan for your investing activity. And I bring this up because what I see in my practice is a lot of investors own businesses or are business people, right? In fact, the majority of them are. And that's how they got their properties. And that's the thing that business people, business owners, business executives can relate to as a business plan. Got to have a business plan. You're out there raising capital, but even if you're not raising capital, you're running the business. You got to have a plan of how you're running this business, or it will run you. So, and in real estate, each piece of property is its own little micro business, and you, as the conductor, you are running the business. All right, it is an investment. So, what we're saying is to create an investment plan, and essentially, this is an investment plan wherein you map out your end goal and then work your way backwards to establish the specific plans to get you there. And what I say by an end goal, why are you doing this? What are you doing this whole real estate investing thing for? Development thing, or owning business purpose properties? What are you doing it for? A lot of people are doing this to set themselves up for retirement. A lot of people are doing this to build generational wealth. A lot of the people are doing this because they want to make an impact in the business world, in the housing community, whatever that is. Let's define what it is, right? And then work our way backwards. To where we are today and what we need to do in the next 12 months, in the next 3 years, in the next 5 years, to move us towards that end goal. And every move we make should be in accordance with that end goal. Very, very important. Very, very important. And so within creating your plan, there's a few do's and don'ts. The first do is, again, begin with the end in mind. And here's just an example of what that might look like. Is, hey, I want to own 20 properties that pay me $10,000 a month, passive cash flow net, because that can support me in my lifestyle. I can live wherever I want. You know, I can pay all my housing bills, and I can kick back without having to go and work and produce every single day. And I'm a real estate broker, right? In the real estate agent world and broker world, many of us, we don't have 401ks and IRAs and all that kind of stuff. And most investors are business people. They don't have that either. So these investments are your retirement. At some point, we're all going to hit even the most aggressive and hard charging people are going to hit a point where it's time to kick your feet up. You know, you're 80 something years old, and maybe you can, go online and check the portfolio out, but you might not be in the trenches every day. I know some 80-year-olds still that are in the trenches though, but there comes that time, right? Or maybe you say, I want to travel the world. I want to be able to generate income that I don't have to grind it out for every day, right? And so you need to start with that. And what does that look like for you? Everybody's end goal is going to be different, by the way, right? And you want to do this without, I say, overpaying taxes. Because like I said in the beginning, sometimes paying taxes is not the worst thing to do. All right. Especially you made a bunch of money, you made profit, you're paying taxes on it. All right. What we don't want you to do is to overpay on taxes. We don't want you to sell a property, pay capital gains, and then buy a property again when you could have did an exchange, right? And you could have planned it out and plotted it out the right way. What you don't want to do in this process when you're setting up your plan, you don't want to overreach, right? You don't want to, like in this example, say, hey, I want to buy 1,000 properties. I'm going to buy 100 new units next year. If you don't have anything, right? You could buy one building with 100 units in it for sure. That's a big undertaking, right? And this is a business in real estate where you can utilize leverage and raising capital, where if you're ambitious, you can quickly move up the ranks. All right. But you've got to make sure that your growth plan is logical and it's dialed into your overall plan. It's just not an ego based, I want to go out here and take over the real estate investment market. It's a plan based on, hey, this is where I want to end up at, and I don't want to take a bunch of. I'm not going to plan on taking losses, right? In business, we take losses, but we don't want to plan on it, and so we want to be methodical in our approach. And that's the now. I don't want to temper your ambition. I don't want to do that. Let's not do that. What I'm saying is don't overreach. Let's make things that are smart goals, uh, that are attainable, but that are a stretch. I do believe in stretching yourself, but with wisdom. And I say this again because the market's in a frenzy, right? Like it's been in. People start overreaching. People start, I'm going to go grab 1,000 units next year, and it's not about, okay, 1,000 units of profitable units. It's just 1,000 units, and whether those units are profitable or not, doesn't matter. And I've seen that happen to where that derails an investor. So do not overreach. Very important. Now, second part of the success checklist is to define your investment criteria. Now, I talk to investors every single day, and I can tell a professional investor versus somebody who is maybe just got a bunch of cash, right? Just because you got a bunch of cash and property doesn't necessarily make you a professional investor, by the way. Because a professional investor can tell me succinctly what their criteria is. I'm looking for properties that are, value add with 20-30% upside, where I can come in, at least a 5.5-6% cap rate on actuals day one. I want to buy a property where the rents are 20% under market. I want to buy a property where, it's in an undervalued area. And I want to make sure that, I'm acquiring that asset because in 3 to 5 years, I want to make a 25%, 30% internal rate of return. Professional investors are dialed into what they want, right? And by the way, they're all different. They all have different criteria. Some people will only buy value-added properties. Some people will only buy fully stabilized properties. Some people will only buy properties that are in Class A areas. Some people will only buy properties in the hood. There's no right or wrong on this, right? And you can read a million books, and I've read a lot of books. You've probably read a lot of books because you're here on this webinar. Everybody's got a different criteria. Everybody's got what they like. Some people like apartment buildings. Some people like office buildings. Some people like hotels. Some people only want to buy single family houses. Everybody got their criteria. The key is to have one and to define it clearly. All right. So here's a couple examples. What I mean by that is, what type of ROI are you looking to earn? Return on investment. And return on investment there's a couple of different measures in real estate. First, we look at cash on cash return. How much cash are you generating annually in relationship to the cash that you put down? Cash on cash return. Okay, the internal rate of return. It measures the cash flow that you make every year, the principal pay down on your mortgage, either the appreciation of the property or the drop in value of the property, and the tax benefits. And that looks at that over a period of time, usually 5 to 10 years, right? So you need to know that if you're saying, hey, look, I had one of my most successful clients. He just says, look, every building I buy, when I buy it, it has to be a value added. And when I'm done making my value add, there's a minimum of $1 million of equity. If there's not $1 million of equity, I'm not messing with it, right? And that's his formula. You got to have your own formula. All right. Now, within that also, you need to know what type of buildings you're going to purchase. What I would suggest is you to get really familiar and have a expertise on a product type, whether that's apartment buildings, office buildings, whatever it is. If you're too spread out, you're not able to really have an expertise and a focus and a niche. And I think that from the successful investors I see, they have a niche. Now, that doesn't necessarily mean, let's say an apartment investor, it doesn't necessarily mean you can't never buy an office building or never buy a hotel, but you should have your specialty dialed in. And if another deal comes your way and it fits your financial requirements of rates of return, and it's another product type, go after it. Just make sure you get that understanding of how that product type operates, right? Office buildings are different than apartment buildings. Hotels are different than office buildings. Industrial properties are different than retail centers. Okay, single family homes individually are, single family homes, right? Everything has their own nuance. That's why the more specialized you get into it, the better. And when you take your time to really map out what your criteria is, You'll also be able to eliminate the deals that are dogs quickly. When you see a bad deal, you can get it out of your way quick. Too many investors spend too much time on deals that they're not going to invest in, right? And you can make $1 million and you can lose it, but you cannot get the last 30 minutes back. You can't get yesterday back. It's gone. So time is extremely valuable. Defining your investment criteria will help you lock in and be more tactical in what you're doing. Now, also a part of this criteria, where is the neighborhoods? You need to dial that in. Okay, there's A, B, C, D, E, F, G neighborhoods, right? So some neighborhoods like D neighborhoods are called like basically war zones. C neighborhoods are the hood. B neighborhoods are kind of like middle income, middle of the road. A incomes are more upper income. A class buildings or neighborhoods are more upper income type neighborhoods. All right, every neighborhood or every neighborhood type has its nuance. There's money to be made everywhere, even the war zones. I've seen it, done a lot of deals there. But you figure that out based on what your goal is, right? What the end goal is. You set up an investment plan on step one. Now we're saying, okay, well, what's our criteria to make that plan happen? And another thing to think about is, are you investing more so for cash flow or long-term appreciation? I believe cash flow is king, but the argument can be made, especially in the California Bay Area, that if you buy properties that are barely breaking even in great areas over time, they're going to appreciate, probably better than those cash flow properties in the Midwest or in the South or whatever. So the key is knowing your plan. That's why we start off with what your plan is. Let's say you're an executive making 7-8 figures. Well, maybe cash flow is not as important to you on your real estate investments, and appreciation is having a safe haven for your capital. That's cool. That's why it's that criteria is yours. It's not everyone else's. It's what you want. Right. And that's why people say all the time, I don't know why people make money in California. They're buying these 4 cap rate, 5 cap rate deals. How do you make money like that? Well, there's a lot of people who pay cash for buildings, and they like real estate. They like real estate for a lot of different reasons, especially in the Bay Area, because over the years, it goes up tremendously in value. Although it's, cash on cash return might not be the best market. But when you look at the internal rate of return, the growth over time, very, very good. So that's why that investment criteria is specific to you and your plan. Now, a couple do's and don'ts on this end. First do, define your minimum rate of return required on each deal that you will do to realize your investment plan goals. And I say start with the minimum. Say, I'm not going to do a deal unless it hits this. And I got this from one of my clients who I just gave you an example. He said, hey, he's not going to do a deal unless it makes $1 million. Right? He's got to that level. It doesn't make sense for him to allocate his money unless there's $1 million involved in the deal somewhere, right? So he's got a minimum that he's looking to make. If you simply said, hey, the maximum, I'm going to make $10 million out of every deal, or you said, hey, look, I'm looking to make 20% cash on cash return, you're going to miss out on a lot of different deals. Versus you said, look, I'm not going to touch a deal unless it's 8% cash on cash return. That 10%, 11% deal, if you said I'm only doing 20%, you missed out on. And that actually was a great property, could have been a great property in relationship to the rest of the market. So you start with your minimum. I'm not doing a deal unless it's this rate of return. I think you got to have a cash on cash return number, got to have a cap rate number. The internal rate of return is more a little bit of a sophisticated number. And if you don't know what those measures of return are, please go to our YouTube station. I've got several videos where I break down cash on cash return, internal rate of return, and the like. All right. But bottom line is, you need to know what the minimum is that you will, if this deal ain't bringing in that, we not doing a deal. All right. Very, very important. The don't on this is don't compare yourself to other investors. All right. This ain't keeping up with the Joneses time. Okay. Everybody, like I just said, everybody invests for different reasons. Some people are investing for cash flow. Like if you have a job or a business, let's say, where you're making a ton of cash, your investment goals may be different from somebody making 60 grand a year who's trying to make it who wants to use this business to make their fortune, right? So you can't compare yourself with other investors, right? What you want to do is stick to the plan, stick to your criteria, all right? And you're also dealing with people who, a lot of investors are not individuals. A lot of investors are well-organized teams, and they run a tight ship, right? So so don't compare yourself to those. Compare yourself to your plan, and compare what you're doing, what you're looking at in relationship to your defined criteria. Very, very important, right? And this business, believe me, even now, if you're brokers and agents out there in the world, hear that as well. We are competitive people by nature. Look, I coach football, I play ball. Competitiveness is definitely an important thing, an important part of success, and you want to be a competitor. You want to have that drive within you. But look, don't try to keep up with the Joneses. If somebody's out there doing something, let it motivate you, let it drive you, but you do you. And I think that's very, very important, because I started in 03. I told you guys I started the company in 09. So I was in the trenches of the Great Recession. And I do a lot of networking. I should, at the beginning of the presentation, I told you all the real estate organizations I'm a part of. So I've been in all the conversations, and people, you know how this business is, pride and ego is going to come up to the surface. Greed and fear run the markets. Let wisdom and diligence dictate your investment plan and your investment criteria. Now, I saw that someone had a raised hand. Thank you. I think Frank had a raised hand. We're going to come back to questions at 6:50. So just hang on there, Frank, and we're going to get to you. Just want to get through the presentation. Now, next thing here. Now, we're talking 1031 exchanges today, all right? Which means that somebody you're working with, the team, somebody's got an existing property that needs to be evaluated, right? So what we're going to do is we're going to make sure that we evaluate your existing property's return on equity. Now look, not the return on investment, return on equity. And here's what I mean by that. And this is more of a term like stock market dudes use this. But what I'm talking about is the return on equity for the piece of property. Essentially, the formula for this is the property's annual cash flow divided by a property's net equity. That's the formula to calculate return on equity. And here's a basic example. Say a 10-unit building in Oakland, which at this point is a deal at $200,000 a unit. To say it's a 10-unit building is worth $2 million. Say you have $1 million mortgage on the property. Now, when you're calculating this, you're always going to put cost of sale in there. So when you sell the building, you're probably going to be 9 times out of 10 dealing with the broker. You're going to have some closing costs. It might even be more than this. I just put $100,000 in there. It's about 5% of the $2 million. Okay, cost of sale. Even if you don't use a broker, you're going to have cost of sale, transfer tax, closing costs, etc. Highly suggest you using a broker if you're going to sell and you're trying to get the best price. Now, after your cost of sale is considered, you get the bottom line number of net equity. So in this example, you got a $2 million property, $1 million mortgage, $100,000 cost of sale. You got $900,000 net equity. All right. So that's what you got to play with. That's if you were to sell this property, that's what your down payment is going to be. All right. Now, the property, let's say, generates $30,000 a year of annual net cash flow. Right? Not bad. That $30,000 per year, when we remember the formula, annual net cash flow divided by a property's net equity, that's going to equal a 3.33 return on equity. So you're making 3.33% on your $900,000. Actually, not bad. However, can we make a better return today? Can we generate a better return by doing an exchange? That is the question that I ask clients when we're doing exchanges. If I'm doing exchange myself, can we make more than what we're making now? realistically, not pie in the sky, right? We talked about that when we're talking about our plan and our criteria. Real talk, right? We're looking at the marketplace. We're looking, and by the way, marketplace is not just what's listed. And in commercial real estate, particularly, what's listed is probably, and what gets sold on the market probably represents only 50% of the real transactions. Half the deals, I would say confidently, happen off market. So you want to also track what happens, what properties are being sold for, what the comps are, what properties are on the market, what properties are in the ethos of being sold. Can you go out there and earn 3.3% or more? And I will tell you, even in the Bay Area, in a very, very expensive market of the Bay Area, right now, you can probably earn more than 3.33%. And in fact, when we do this analysis, however, most people's return on equity, what I find in reality is more like 1 or 2%, right? And if it's 1 or 2%, if it's less than 3%, you're definitely not even keeping up with inflation. And inflation is something we all got to think about these days, right? So in this instance, you might be in a great position to exchange, even in today's market, where you would be able to increase your cash flow, purchasing a better asset, like we said, which is the bottom line reason we're doing this exchange, in order to expand your portfolio and your cash flow. But what happens is a lot of us do not do this analysis when we're considering our exchange. And I think this is very, very important. Also important when you're negotiating, when you're selling your property and you're negotiating for the other property, to consider all these factors, right? A couple key things I want to note, point, just for anybody who's not so familiar with the exchange process. I said in the beginning, you have to purchase a property of equal or greater value. So when you exchange this $2 million asset, you've got to buy at least $2 million or more in order to fully qualify. When I say fully qualify, defer all of the capital gains taxes. You've got to spend that $2 million of value or more. And there's ways when you identify properties, you can identify up to 3 properties that you purchase. And when you're doing an exchange, there's a time clock associated with this. When you close escrow, you've got 45 days to identify up to 3 properties. Now, there's a second way to identify, which is called the 200% rule, where you can identify as many properties as you want. You're not restricted to 3, but they cannot exceed 200% of the value of the property you sold. That's a lot more complicated way of doing it. I suggest sticking to the 3 property rule, but a lot of times investors purchase portfolios and there's more than 3 properties. So I just wanted to, put that out there in terms of some of the technical pieces of the exchange. And the last thing to say on that note is when you're selling and you're replacing the value, so you sell 2 million, you have to at least buy 2 million or more. You also have to carry the debt, and a better word is replace the debt. So when you sell this $2 million property, you have $1 million of mortgage. When you sell, you've got to carry that $1 million of mortgage debt into the next property. You can pay that loan off and go get another loan or have the seller carry financing, but you've also got to carry debt into the next property. Another key thing that a lot of people miss is that you have to, and the rule of thumb for this is spend the cash and replace the debt. All right. Very, very important, especially as debt is important and when we're talking about evaluating the return on equity of a property. All right. Now, a couple do's and don'ts here. Now, like we just said, you have to calculate the ROE on a property. And you need to know that even though you may be getting a low amount, the marketplace is generating low rates of returns, you need to know where you are at now with your equity, because you might be able to increase your cash flow in today's current market. That's why you have to do this calculation. And you need to know what your net equity is and the return you're earning on it. Now, by the way, that number is different from your return on investment, right? It should be. When you bought that 10-unit property, let's say, you didn't put 900,000, you probably put 400 or 500 grand, right? And that 400 to 500 grand grew into 900,000. So that's why it's important not to, and that's the don't. The don't is do not confuse return on equity with a return on investment. It's two different measures here. You know, the cash you put in that place hopefully grew into a lot more equity. And when you sell the property, you have all of that equity to be able to, and if you we're doing this right, exchange right, you're deferring the taxes. So all of that equity can go to the next property. And that's how you can, even if the rates of returns are low, you can still make more. Okay. Now I've got, this is, it gets a little technical. I got a bunch of videos on YouTube on ROE versus ROI. Check that out. But you need to understand its basic formula, but you need to understand that when you're considering these exchanges, because that net equity you have, that's the dough you have to play with in the marketplace. And what I said in the previous, this example on the do is you might sell and only be making 3% on your equity, and you buy a 5 cap rate, right? Buy a property that generates a 5% cap rate and get a mortgage at 3.5% and be making around 6% on your money. If you're making 6% on that 900,000, then you probably just about doubled your cash flow. And that's the power of these 1031 exchanges. And it's how and why, even in markets like this, people are exchanging every single day and making more money. All right. Don't want to confuse ROE with ROI. Very, very critical. Now, you need to decide if the exchange will really increase the return on your property's equity. At this point, we've done the analysis. We really need to look at what's going on the streets to see if we can take this money and go out there and make more money. Remember what we said at the beginning of this presentation. The purpose of this whole thing called 1031 exchanging is to acquire a better asset. So now that we've done our analysis, we really need to evaluate the existing marketplace to determine your property's equity, if your property's equity can generate more cash flow with the new purchase. And I think we should do this before we list the property and put it on the market. Very important. Now, like we said here, it's the same thing, going back, evaluate the return on equity and where your return of investment was, right, when you bought it. Now, probably your return on investment that you're earning from your initial investment when you invested into the property is, you know, you're probably not going to get that in the market if it's a hot market today. All right, maybe you bought that property and you're earning 15% cash on cash, but you're only earning 3.3% on your equity, right? So it may be unrealistic to think you're going to get 15% cash on cash again. And that's what a lot of people get stuck on. Hey, when I bought this property, I made 15%. I ain't gonna buy no property unless I make 15% on it. Well, in the marketplace today, that might be overreaching. But you, like I just said, if you're only making 3.3% return on equity, you could buy a 5% cap rate and make 6% on your money, 6% cash on cash if you got a mortgage, and double your income. You don't need to get the 15% cash on cash you got before in order to double your income or buy a better asset. That's why this is very important. Now, we do need to know what's going on in the marketplace. And you don't, here's the don't want to get discouraged based on the expensive pricing today. That's easier said than done, though, because when I look at these prices, and I've been around for a while, you know, discouraging is not what we want to feel, but it's like, man, what are these sellers thinking about? But then you look at the sales comps and be like, well, what are these buyers thinking about, right? They're doing deals. They're doing deals that make sense for them. Some people might be idiots, and there's a bunch of idiots out there, but a lot of people are doing deals that make sense for them. So we got to see, well, where are the sales comps? What's going on? We got to really analyze this and do it with a non-emotional, analytical mind, not a like, oh man, what am I going to buy? What am I going to do? Do I have to go out of state? So on and so forth, which you can do, by the way. And I'll get to that as well. You don't have to stay stuck in your own marketplace. That's why I'm saying, don't get discouraged by the expensive pricing in today's market. If we understand the measures we just talked about, we can dial into this process and really execute. All right. Now, You need to identify a primary, and I would also say a secondary geographical location where you want to invest. Ideally, you can invest in your backyard, but that's not your only option. All right. And you can do very well investing outside your area. Just beware of the pitfalls. Okay. Beware of the pitfalls of investing outside your area. But you don't, I just want to say, if you can invest in your backyard and that's what's comfortable and that's what you do, you still can exchange in today's market and make money, make more money, buy better assets, but you don't have to be limited by that. All right. And there's a guy by the name of Dave Lindahl, which is he's one of the multifamily, gurus, but he's an excellent teacher. He's got excellent content. And what he talks about is market hopping. He does a lot of that. He teaches that, identifying which markets are hot, selling, exchanging out of where you are now, finding the next up and coming market. That's a real technical way to do it, but you make a ton of money when you do. But you have to know some of these do's and don'ts. Now, if you are going to look at either your area, or you should look at your area, you should reanalyze it, because you should be selecting an area where there's positive job growth, positive population growth, and also an area you think is cool. I threw that in there because look, this is a sticks and bricks business. You got to get out there, feet to the street, man. And say you're out there traveling to your property in the middle of nowhere, Idaho, versus could you buy a property in, San Antonio, Texas, or somewhere where they got some, the river walk and stuff to do. It's life. You're living. But they got to have positive job growth, positive population. If the jobs are shrinking and the population is shrinking, the rental demand is probably going to shrink, right? And that's what, the rental demand is what drives our business. So, understand that. And I'm not saying go to Vegas, but find somewhere where it's a cool place to go. A lot of, I do a lot of business in Oakland. I invest in East Oakland. I work in East Oakland. For me, driving through there is cool, for the most part. But I can understand how some people, they might not want to go through there. They might not want to have to go and check up on their investment property through that neighborhood, right? So just consider that all. At the same time, a bunch of money to be made in those neighborhoods, right? Now, the don't is, I just think don't limit yourself to only what's available in your backyard. There are chances out of state, all right? And this is another don't, it's not written here, but just if you are out of state, if you're going out of state, do not compare or out of the area. I'll give you an example, like out of our area, I'm in the Bay Area, Stockton, the Central Valley, that's out of our area. It's in the state, Northern California, our, general area, but it's not in the Bay Area, right? If you are going to go out of state or out of area, do not compare those prices with the prices of properties in your marketplace. Do not compare those cap rates and rates of returns with your marketplace. Compare the properties, cap rates, price per unit, price per square foot with that marketplace. Very important. Bunch of California people go to Texas. Oh, it's cheap. It's cheap. It's cheap. I'm going to buy it. But you're buying the most expensive deal in San Antonio or Dallas or Houston. You want to compare apples to apples. Look at that property in relationship to other properties in that area. Very important. Now, key to this whole thing, I think, 1031 exchange success is finding off-market deals. All right. And this is where working with a broker really can help out. And a lot of investors think, oh, I don't want to work with brokers. But all the top investors I know work with brokers. They can do their own thing as well, but they work with brokers primarily to find them deals. Okay. But even if you don't work with brokers, and a lot of successful investors have their own system for finding, they don't only rely on other brokers. All right. So here's the biggest thing, though. You need to start this process before you're finding off market deals, before you sell the current asset. Very, very important. Whether it's off market deals or whatever, you need to start now before you sell. It's very important here. Now, a couple do's and don'ts out here. First do, yes, reach out to a commercial broker, an investment broker. All right. Now, particularly when I say commercial brokers here, there's some commercial brokers may only do institutional type deals or only do leasing, that may not be the guy or gal for you. You need a broker that is an investment broker, right? Unless you're selling a business purpose property. And maybe that person is a corporate investment broker or corporate broker and they do corporate properties. Maybe that works for you. We're talking investments. You need an investment broker. All right. Now, you don't have to commit to this broker, only working with them, but you certainly want to reach out to the top brokers. And the reason you want to do that is top brokers are going to have properties we have listed. And we're going to have 3 or 4 at least properties that we're working on getting listed, or we have the listing agreements and we're preparing them for sale. Or we have talked to the sellers and they're like, yeah, well, I don't want to list right now. I do want to sell. If you got somebody, bring it to me. Any broker worth their salt has at least 3 or 4 of those deals. That's why you want to tap into those guys. All right. And these are the professionals who are pounding the pavement every single day of the week. Like it's me. I got 22 agents. We're cold calling, we're emailing, we're marketing, we're doing whatever it takes to bring deals to the table to our clients. Right. That's why you want to reach out to a commercial investment broker. What you don't want to do is limit yourself to what's on the internet. A lot of newbie investors do this. Oh, it's on LoopNet, it's on CoStar, it's on MLS, it's on Redfin. That's cool. That's a snapshot. But like in commercial investment properties, half the deals don't even make it there. So you don't want to limit yourself to half the marketplace. Very, very important. I won't spend too much time on this. Now, I got another video I just released about finding off-market deals where I go into some of the actual websites that we use and strategies that we use to actually find off-market deals. That's available for free on YouTube. Check that out. But reach out to the broker community and pound the pavement yourself as well. Do not just look for what's on the internet. All right. Now, you need to map out, as we get ready to wrap this thing up, you need to map out your timeline up front. Before you begin with the exchange, map out every step of the way, leaving nothing to chance. So when I'm talking about a timeline is this. The 1031 exchange process is time sensitive. When you sell your current property, which is called the down leg, all right, what's called the relinquished property, that's the technical language, relinquished, we call it down leg. That starts a time clock. You have 180 days in which you have to close escrow. Within that 180 days, you have 45 days. Now, these are actual calendar days, not business days, and holidays are included in this. Within that 180-day time period, you have 45 days in which you need to identify. You need to identify what properties you're going to purchase. We talked about that earlier in the presentation, the 3-property rule or the 200% rule as different ways of identifying your property, what's called the replacement property, the up leg, the property you're going to purchase. You need to sit down and map this out before you list, okay? And then you can say, okay, I'm going to take 2 or 3 weeks to get the property ready for sale. We're estimating property to be on the market anywhere from 2 to 4 weeks, typically in our market. And it's going to take, anywhere from 60 to 90 days for an escrow. If it's cash, it could be 30 days. All right. Therefore, before you list the property, you start, do everything we talked about, map out your criteria, reach out to brokers, get your financing in order, start looking for replacement properties, and then move forward with getting your existing property sold. I know this seems simple. I know it seems basic, but so many people miss this. And I deal with this all the time where I'm saying, hey, we're selling a property. All right, we need to be looking at property. No. I don't want to think about properties until we sell this one. And then we're going to be under a time crunch. All right. You don't want to do that. What you do want to do is begin looking for that replacement property long before you sell it. And there's these things called reverse exchanges. Now they're very expensive and complicated, and we can avoid doing that by following our 9-step process in this 1031 success checklist by looking for the replacement properties first and beginning that process first. Going through this 9-step program will help you to be able to do that. All right. You want to start that process early. Ask yourself these questions. When are we going to be closing on the up leg? When is our replacement identification deadline? When do we plan to close the down leg? All right. How long is it going to take me to finance this property? Am I able to finance this property? Right? Are we going in all cash? Do we, all these types of factors up front? Because what you don't want to do is start looking for the property after you sell the down leg. So when you're in that 45-day period of time, and I've been there a million times, okay, now it's like you're trying to make a touchdown pass. It's 4th and 25 in the cold. Now, I know this weekend of football, we saw Patrick Mahomes and Josh Allen and all the quarterbacks making these crazy, touchdown passes with 1 minute left and all of this stuff. That is extremely difficult, by the way. Can you imagine that pressure of that? Now, the reason those guys get paid the big bucks is because they perform well under pressure. All right. But let me just tell you, for most of us, when stress and pressure and time deadlines kick in, our ability to think clearly and logically and wisely diminishes. It goes down because that pressure puts stress on you, and stress puts cortisol in your brain, and you can't think as good. Now, some people rise to the occasion, throw that touchdown on 4th and 25, right? And you want to have those kind of skills to bob and weave. What we're talking about is a process to eliminate the helter skelter so that you're not in that 45 days throwing mud against the wall because you don't want to pay taxes. Remember, this whole process is about acquiring a better asset. All right. And we've witnessed people make this mistake time and time again. We've been in there, you know, with the stress. And that's, let me tell you, you can have millions of dollars in the bank. When you're looking at paying 30 to 40% capital gains, it's a little bit of stress. So let's attack this in a methodical way to minimize that stress and already have options on the table before we even sell. And I'm telling this as a broker, saying, hey, I'm a person who gets paid to sell the property. All right. Let's just use some wisdom and some diligence in this process is my whole point. All right. And you want to make sure you qualify and identify. I'm going to wrap up here next couple of minutes. You want to qualify that replacement property detailed. All right. You want to compare that property. When now you're looking for properties, you want to compare it with your criteria and making sure that's in line with your plan. All right. You want to begin making offers even before you sell your property. Don't be gun shy. This is the time to use letters of intent so you're not bound, but to get offers on the table. Be aggressive in this point. All right. And this is again where the right brokers come into place. And make sure you're communicating with what's called your qualified intermediary. Your qualified intermediary is this exchange company who handles the exchange. When you close escrow, the money doesn't go to you. It goes to the QI, the qualified intermediary. It sits there until it then is going to be deployed to the other properties. All right. What you want to do is conduct thorough due diligence on each potential property and begin making letters of intent prior to closing the sale of the down leg. Very, very important. Very important here. All right. And I've got other videos on due diligence. We won't go into that now, how to analyze properties, what to look for, but you need to do thorough due diligence on the properties that you're closely considering. What you don't want to do is only select one property without any adequate backups. A lot of times people zero in on a property and say, this is what I'm going. Hey, understandable. That's a great thing to do. Have a couple backup plans. Have a couple properties in backup. All right. And there's DSTs out there you can use as backup. There's all kind of things, but please have a couple of backups. Once you identify and once you pass that 45 days, you are locked into whatever you chose. Very important. And the last thing is to work very closely on your escrow, closely and diligently when you're in escrow to close your replacement properties. Also to close your relinquished properties. But certainly now when you've chosen this property or properties, you're in your identification period and you're in escrow to close, don't let a little moving part in that escrow blow your exchange. And I've seen this happen before, right? You have to be on top of everything. And a lot of people sometimes get hands off in this. So let my brokers or my handlers handle this. This is the time to be a little bit dialed into this, making sure that the broker's on point, making sure the escrow, the loan officer really is the one you really got to be on, and making sure everything is tight and right. right? And another thing to point out is you don't want to be shopping your loan everywhere, but you need to have 2 or 3 backups in case your lender falters. All right. And I hate to say that, but having been in the mid deal and the lender say we can't do the deal, that can be a bone crusher. All right. So you have a couple of backups in place. Smart investors always have that anyway. All right. Not you don't want to be shopping your deal though. There's a fine line. Shopping your deal means bringing your deal to a million different brokers. They're all in the same network, so they're gonna know you shopping their loan after a while, and then they're gonna discount you or not pay attention to it. But do have a couple of backups, and so that's what we were saying here. You want to work closely with that lender to ensure this deal closes and closes on time. All right. And the last thing you don't want to do is you don't want to get complacent. You do not want to get complacent in this. Be dialed in, eye on the prize, eye of the tiger. All right, fourth quarter, it's time to ball. You know what I mean? This is the time for that. So, with that being said, I want to wrap this up. We would love to work with you. You know, call our office, go to our website, book an appointment. If you're considering this with us, book an appointment and let's sit down and talk about it. If this is something that's far off, still book an appointment, plan it out. Let's talk about it. Our goal is to develop a long-term relationship with you. We're brokerage, so we do these webinars. We're not selling boot camp seminars. Come to the boot camp and spend $15,000 and teach you how to invest in real estate. We're a brokerage. We sell properties and we help people do 1031 exchanges. A lot of those exchanges, and so if you're interested in that, book an appointment. Let's sit down and talk. Now, we got a few minutes, and I'll stay here to where I went a little bit over, but I wanted to drill this in. I wanted to address any questions that we had. I don't see any questions in the Q&A. There was Frank. I want to say Frank had his hand. There was Frank Pinder had his hand up. Frank, if you wanted to ask your question, go ahead. Would love to hear what you have to say. Let me go to the chat and see if there's any questions. Okay. Frank says, question was answered during the presentation. Appreciate that, Frank. And we did this presentation. It literally took us a year. We took a year last year. We've done a lot of research. We've talked to a lot of buyers, sellers, investors, analyzed deals that we closed. And we have a marketing team that we said, okay, we're going to put together with this 1031 success checklist with absolute diligence of what is everything you need to know when you're exchanging and executing on this in this process. Right? It's not easy. It's absolutely totally worth it. And something that I think is, it's the great formula to wealth in real estate. 4 greenhouses, 1 red hotel. And if you're just like the Monopoly game, right? If you're executing on this consistently, then you're going to see your portfolio expand. Now, having the right team in place is important. We talked about brokers, property managers, attorneys, accountants, insurance folks. You're essentially running a business when you're doing this. Make sure you have the right team in place. When you're doing an exchange, your qualified intermediary is a very, very important piece to that puzzle. I use IPX 1031 Exchange, Ron Ricard, James Callejas, a couple of guys that I typically work with, but also I've used Teresa Moss Flugel from Chicago Deferred Exchange, Avery Johnson at First American Exchange. He's a great exchanger. And make sure that you are, when you work with your qualified intermediary, you're working with a reputable company that is bonded and insured, because the money leaves that account, it leaves escrow, it don't go to you, it goes to the qualified intermediary, right? And if you don't identify properties, it has to stay there with them for 180 days. All right. So if you don't buy properties through them, they got to hold it for 180 days. That's the rule. You can't just take it out and cash out and go buy something else. So make sure that you're dialing into this process, and make sure that you are working with the right qualified intermediary. I think that is it in terms of, let me see. Looks like Frank says, Could you post the phone number, email, and website in the chat? Yes, I will. I will put that in the chat. You guys will also receive an email with our checklist. It'll have all that as well, but I'll put it in the chat. Deetra Harris. Deetra, thank you for saying great. And Deetra, thank you for joining. Deetra's a developer. She's got an amazing project that she's doing on 12th Avenue, converting an old church into housing. And so, Deetra, thank you for joining. Really, really appreciate that. Pay attention if you guys are interested in housing and in Oakland. That project is going to be an amazing project in the city of Oakland. Bring some housing, and we've got to do more projects like that. Where we have all these people on the street and a housing shortage, but we got all these vacant properties not productive. So very, very important. Shanika Thomas says, that's awesome. Yes, that is awesome. What Deetra is doing, that's amazing. Thanks, Frank. I'm going to put my information in the chat. Also hit us up on YouTube for sure. That's where all of our content is going to be, on YouTube. We put everything on YouTube. It's just my favorite place to store content. Please make sure that you guys hit us up on there. Our goal is to get to I want to say 3,600 subs this year. Now, I know it's little kids, doing TikTok dances that got like 1 million subscribers in our space, and we're providing really just straight up real estate education. For me to get to 3,600, that would be huge. And if you guys like that content, share with friends, share with others, get the word out. I think as we go forward in the rest of this year and the rest of this marketplace, we need quality information. We need quality information to the people. And that's what we're doing. That's what we're doing. Good market, bad market, sideways market. We're a small company. We're growing. We're not perfect, but we are dedicated, and we are dedicated in getting this right for our clients and for you guys. And so I really appreciate you all who joined in. Wishing you all the best of success. We're going to end this up now. This will be, you guys will receive an email with all the contact information. You'll receive an email with the checklist, and you'll also receive an email with the replay, the video that will be going on YouTube. So again, if you missed, or one of your friends missed it, get them on this, share this knowledge with them. I hope it was helpful. I hope you have an amazing rest of your evening, rest of your week, and make 2022 your best year yet.